Well, China has been the growth driver of oil for 15, 20 years now. So anything that goes bad with China is going to exacerbate concerns that are already pretty significant about demand and the fact that we simply have too much supply. So the other extraordinary thing that we've seen here, as you know, is the situation in the Middle East is extremely tense, but oil can't get out of bed. And that's because there's so much spare capacity and so much U.S. production growth. The spare capacity is just going to sit there in Saudi, Middle East. What we have to also get rid of is some of this U.S. production growth, and that's going to take probably even lower oil prices. We're
going to hear from Chevron, which is down 2% right now, also from Exxon tomorrow. But today, Concho, one of the better names in the sector, down huge. What is that telling you about everybody else?
Well, for Concho, we're hoping to hear from Chevron. We'll see. No, it was a shock. You know, Concho is a very highly regarded company. It's a very good play on the Permian. And the management have just misjudged how to manage market expectations. Obviously, it was a shock. The results last night after the market were a shock to what has been somewhat of a premium stock. You know, so the issue for Concho was it's highly regarded, therefore it's coming off a higher base. And when you have these misses or disappointments in terms of what they actually reported, that's why we got such a radical sell-off in the stock this morning.
Is there anything on the horizon that would redress the fundamental problems that you just described, which is a lot of excess capacity and falling demand?
Well, you know what the cure for prices is, right? So it's looking pretty scary. I mean, the demand side, as you know, is very mature, notwithstanding China's importance. The fact is that a really strong year for demand would be 1.5 million barrels a day. A really terrible year would be 500,000 barrels a day because you've got just natural population growth. So you can really only expect around 1 million at best of variation in that particular metric.
In demand.
In demand, which is the most important thing, obviously, in terms of how the market sees the world, because everything else follows from that. At the moment, we've arguably got 1 million barrels a day too much U.S. supply growth.
Wow, U.S. supply growth.
Yeah, exactly, because nothing else is growing that much. It has to be said there's also non-U.S., non-OPEC growth coming through as well. So the total amount of excess supply for next year looks as much as 1 million barrels a day without further concerns on demand. The way you'll balance that, because the other supply coming is very long cycle, big mega projects that are going to start up and run, is some of the shorter cycle stuff, and that's where the concerns center around the Permian and the U.S. unconventional.
And we were just showing the price levels. Brent is barely above $60 right now. WTI, as we mentioned, is around 54 and change. It's down 7.5% again today. So what levels realistically now are we talking about? A major reset here, lower, or just staying? What happens even if we just stay where we are today?
Well, it's a fascinating, about 55 is a fascinating price for WTI because that's exactly the point of zero free cash flow for the average U.S. unconventional player. So the market's balancing right at that point of challenging the strategy of the managements in terms of what are you going to do at 55? Are you going to generate some free cash flow? Are you going to keep growing at 20+% like Concho were? And the question will just continue to be asked by the market, obviously, to the downside potentially if we don't see some tempering of growth and some reduction in capex. The market is begging these companies to spend less and grow less and generate more free cash flow.
What if I'm long some of those companies that are heavily exposed in the Permian? What do I do?
Here it's very tough. I mean, a good example is Concho because they have such good assets, you know, and it is the Permian and it is very, very important for the future of global oil. So I think, you know, our view is that one way or the other, whether it's Concho getting itself out of this mess and having a good 2020, which we can see, or the potential for M&A is there in the case of the Permian names. But it's certainly been a very tough ride for investors. I wouldn't advise you to sell Concho here at all. I would do the opposite. But we were certainly disappointed by last night's results.
Is this going to slow Texas? I mean, at what point if you're saying the market wants them to spend less, to grow less, are these regions still going to remain strong or are they going to start slowing precipitously?
Yeah, for years, I've never been able to quite prove this, but I've argued that high oil prices are good for the U.S. for several years now because of the importance of the primary aspect of investment in oil in places like Texas and the fact that essentially the potential is there for U.S. consumers to become a lot more efficient in using oil. So it wouldn't be bad for people to have a bit higher prices, in my view, and be a bit more efficient. So, you know, we're looking at a very interesting balance in the market. One thing I didn't mention as well is it's pretty depressing because seasonally this is about as good as you get in oil. We're in the middle of peak demand in summer.
Wow.
And things tend to get weaker as we go, you know, through the rest of the year. And finally, you've got to think about the dollar. The dollar's actually indicating lower oil prices as well. So it's a pretty, it's strong. So, you know, it's a pretty scary, scary tape out there for us, I'm afraid to say.